So we'll talk about salary sacrifice, transition to retirement, and those other strategies for the remainder of the session. Now, salary sacrifice, there are a range of questions about this. I'll just explain how it works when you're not salary sacrificing. Is your employer puts in, or your employer deducts tax. Pay-as-you-go tax is deducted from your income before your money gets directed to your bank account. And depending on how much you're earning, if you're earning between $20,500 this financial year and $37,000, you'll pay tax at 20.5% if you include the Medicare levy. If you're earning between $37,000 and $80,000, you'll pay tax at 34%. And over $80,000, it's $1,000. Between $80,000 and $180,000, it's 38.5%. And then over $180,000, 46.5% tax. So your employer deducts, something in the order of that sort of tax. It's not exactly those amounts, but it's a withholding tax amount that the government sets. Deducts that tax from your pay, and then whatever's left, they direct to your bank account. Then you can spend the money, you can save the money, you can direct money to super. In the scenario where you make a salary sacrifice, or you have a salary sacrifice arrangement, what occurs there is that your employer, before deducting tax, directs money to your super fund. Now, the key point here is that when they do it in this way, they deduct your super fund, not your employer, deducts contributions tax. But the key point there is that the contributions tax rate is 15%, not the 20.5, 34, 38 or 46.5% tax that you might pay if you receive the money into your bank account. So that's the key difference. So actually, you'll pay 15% if your income is less than $300,000 this financial year, or you'll pay 30% contributions tax if your income is higher than $300,000. So, because they've deducted this or taken out this superannuation contribution and put it into your super fund, that reduces your taxable income, and therefore they deduct less PAYG tax. Then they put the remaining amount into your bank account. It's a lesser amount, but it means then that you don't necessarily need to put money into your super fund after paying tax. You can spend the money, save, and in some cases you might also put some super contributions in after tax as well to get access to the government co-contribution is an example of one of them. So the key value of the salary sacrifice arrangement is the difference between what you pay tax at your marginal tax rates and the contributions tax rate. And this financial year, salary sacrificing down to an income of $20,500 is valuable. So it actually, the new tax thresholds increase the value of salary sacrifice for people on lower incomes. And that's the key difference. So the benefit is the difference between your contributions tax rate and your marginal tax rate. So even if you're earning over $300,000, you pay contributions tax at 30%, although there are some other complexities there as well.